Welcome back to the deep dive. It is February 7th, 2026, and if you have been watching the markets lately, you know the tension is it's absolutely palpable.
It really is. It feels like everyone is holding their breath.
Everyone is scrambling, it's a gold rush, but it feels different this time, Everyone is looking for the next big thing in AI, the next NVIDIA, the next trillion-dollar software play.
Of course, that's where the headlines are.
Exactly. But while everyone is looking up at the cloud, there is a quieter, much messier, and frankly, much higher stakes battle happening right down here on the ground.
That's so true. We often forget that the cloud isn't actually in the sky. It's in big, loud, hot industrial buildings full of silicon and copper. And right now, there just aren't enough of them.
And that is where today's focus lies. We are doing a deep dive into Applied Digital Corporation, ticker APLD. Now, don't let the name fool you. This isn't your typical tech company.
Not at all.
Think of them more like an industrial landlord. They are sitting on a market cap of nearly $10 billion, but they are also sitting on a powder keg of debt and a massive opportunity.
Right. The big question we're trying to answer today is this company building a durable moat around the AI revolution, or is this a speculative bubble that's, about to pop?
That's the whole bowl game. But before we dive in, this analysis is brought to you by stockanalytics.ai. Get institutional-grade research on over 600 stocks for just $10 a month. Plus, request any ticker and download your own video analysis. Start your 7-day free trial at stockanalytics.ai. Now let's get into it.
So to set the stage for this deep dive, we've pulled together a massive stack of research. We're talking about the latest Intelligent Investors Guide report from just this morning, their Q2 2026 earnings call transcript, recent SEC filings, and a breakdown of their big spinoff news.
And our mission today is to decode the real story behind that ticker. Because when you look at APLD, you see a stock that has gone up over 340% in a year. You see all this excitement. But when you start to peel back the layers, you see some really, really complex mechanics.
Well, absolutely. It's not a simple story.
So let's get organized.
Part 1, chapters 1 to 3, business, management, and financials.
Chapter 1. Business understanding.
Okay, so let's start with the absolute basics. Who are these guys?
Right. Because a few years ago, if you looked up Applied Digital, you wouldn't have found an AI factory builder. You would have found a crypto miner.
And that's the critical pivot point. Honestly, you can't understand the company today without understanding that history. The origin story here is really about survival and adaptation.
So they started in the crypto gold rush?
They did. Originally, this company was built to host cryptocurrency mining, specifically Bitcoin. And the business model was, deceptively simple. Find cheap power, plug in a bunch of ASIC miners, and just let them run.
Right. And for those who don't know, an ASIC miner isn't some kind of supercomputer. It's basically a glorified calculator that does one single thing over and over again really fast.
Exactly. It's rugged. You can basically throw it in a shed with a big fan. But then, as we all know, we hit a crypto winter. Margins got absolutely crushed. Bitcoin plummeted.
And a lot of companies in that space just went bust.
A lot of them did. They went under because their entire revenue model was tied to the price of a super volatile coin. It was a disaster for them.
But Applied Digital didn't. They looked at their assets and realized they had something valuable that wasn't Bitcoin.
They realized they had power. And not just any power, they have infrastructure. They have the land, the permits, the connections to the grid. The analogy I like to use is renovating a warehouse. Imagine you own a massive warehouse that was storing, say, old tires. That's the crypto business. Suddenly, the tire market crashes. But at the same time, Amazon calls and says they need a new distribution center, like yesterday. You still have the roof, you still have the loading docks, and most importantly, you have the electricity hookup. You just need to change the shelving.
So in this analogy, the old tires are the Bitcoin miners, and Amazon is the AI boom.
Precisely. They shifted from hosting crypto to building what they call AI factories. These are high-performance computing, or HPC, clusters. But here is the catch: renovating that warehouse isn't as simple as just swapping tenants. AI tenants, unlike crypto miners, are incredibly high maintenance.
I read about this difference in the report, and it seems like a massive engineering hurdle. A Bitcoin miner is like that rugged tenant you mentioned. You can put it in a shed, and if the power flickers, it just reboots and keeps mining. No big deal, right?
Correct. If a Bitcoin miner loses power for 10 seconds, you lose 10 seconds of revenue. It's pennies, literally pennies. But an AI cluster, we're talking about thousands of NVIDIA H100s or the new Blackwell GPUs all wired together. That is a completely different beast. These things require what's called Tier 3 data center standards.
Tier 3 sounds impressive, but break that down for us. What does that actually mean physically? What are they building?
It means massive redundancy. It means you need uninterruptible power supplies or UPS systems, basically giant batteries, so the power never ever flickers. If you were training a large language model like GPT-5, that training run can take weeks or even months.
Months on a single task.
Right. And if the power cuts for a millisecond, you could corrupt the checkpoint and lose weeks of work. That's millions and millions of dollars just gone. Poof. Plus, you need incredibly precise thermal management, often liquid cooling, because these chips run unbelievably hot. And you need super high-speed fiber connectivity. So Applied Digital had to spend a lot of money and a lot of engineering effort to upgrade their warehouses to be suitable for these new high-maintenance aristocrats of the tech world.
And that leads us to their core thesis, which is this concept of stranded power. This is really the secret sauce, isn't it? It sounds almost like a scavenger hunt.
It is the economic engine of the entire company.
Yeah.
Here's the problem the industry faces. If you want to build a data center today, the traditional place to do it is Northern Virginia, specifically a place called Ashburn.
Right. Data Center Alley.
It's the data center capital of the world. Something like 70% of the world's internet traffic flows through there. But the problem is, everyone is there. The grid is completely saturated. If you go to the utility company in Ashburn today and say, hey, I need 100 megawatts for my new AI cluster, they'll tell you to take a number and wait 5 to 7 years.
5 to 7 years. In the AI race, that's an eternity. I mean, that's like 3 generations of chips from now. You'd be installing obsolete hardware by the time the plug went into the wall.
Exactly. You'd be deploying obsolete hardware. It's a non-starter. So Applied Digital took a completely different approach. They said, we don't need to be in Ashburn. They went to places like North Dakota and Utah. They found wind farms and other energy generation sites that had stranded power.
Define stranded power for us. It sounds like electricity that got lost on the way to work.
It essentially is. It's energy that is being generated usually by renewables, like wind farms, that literally can't get to the city. The transmission lines, the big high-voltage wires that carry power from, say, North Dakota to Chicago or New York are full. They're at capacity. Or in some cases, they just don't exist.
So you have wind turbines spinning, generating all this clean electricity, and there's just nowhere for it to go.
It's stranded. It's a bottleneck at the source. So APLD shows up and says, we'll take it. We'll build the data center right here, behind the meter.
And the key insight, and this is why this works for AI, is latency.
Yes. This is so important. If you are a high-frequency trading firm, you need to be in New Jersey or Chicago to be physically close to the exchange because the speed of light actually matters. You need to be microseconds away.
Right.
But if you were training a large language model, that training run is a batch process. It's a long, intensive calculation. You don't really care if the server is 5 milliseconds away or 50 milliseconds away. You just care that the power is cheap, reliable, and massive.
So they are engaging in geographic arbitrage. They are building where the power is, not where the people are. That makes total sense. Now, let's unpack the business structure itself, because up until recently, it's been a bit of a hybrid.
Right. They have 2 main segments, and this is crucial to understand because they're actually in the process of splitting them up as we speak.
Okay, so what's the first one?
First, you have the data center hosting segment. This is the infrastructure side.
The landlord business.
Yes, exactly. This is the utility model. They build the building, they secure the power, and they sign a long-term, like 15-year lease with a tenant. The tenant pays a fixed rent per megawatt. It's very stable. It looks a lot like a real estate investment trust or a REIT.
And they don't have to worry about the price of electricity going up and down?
Nope. They pass the power costs directly through to the tenant, so they aren't exposed to those fluctuating prices. It's boring, but boring is good for predictable cash flow.
Okay, that's one side. And then there's the other side, which is much, much flashier.
That's the cloud services segment, which they call ADC. This is the tech model. In this scenario, Applied Digital doesn't just rent the room, they buy the furniture. They go out and purchase the NVIDIA GPUs, they install all the complex networking fabric, and then they rent out that computing power by the hour or by the month to developers.
This sounds way more profitable on a per-transaction basis, but also way riskier.
It is. The revenue numbers are huge because you're charging a massive premium for that hardware. But the depreciation is absolutely brutal. A building can last 30, 40 years. An NVIDIA H100 GPU. In 3 to 5 years, it's an expensive paperweight.
Obsolete.
Completely. So the capital expenditure risk, the risk of buying the wrong chip at the wrong time, is much, much higher.
And that leads us to the moat. We touched on the speed getting online in 12 to 24 months versus 7 years. That's a huge head start. But what about the technology? The report mentions waterless cooling. Is that just marketing buzz, or does it actually matter?
No, it's a big deal. This is a huge differentiator, especially for ESG, environmental, social, and governance concerns. Traditional data centers use evaporative cooling. They essentially sweat to stay cool, consuming millions and millions of gallons of water a year.
And in many places, like Utah or Arizona, water is becoming as scarce as power.
Exactly. You can't get a permit to build a giant water-guzzling facility in a desert anymore. Applied Digital uses a proprietary closed-loop fluid cooling system.
So it's kind of like the radiator in your car?
It's a similar concept, yeah, but much more sophisticated. It allows them to get permits in water-stressed areas where other companies would get flat-out rejected by the local municipality. Plus, it's more efficient, which lowers the PUE, the power usage effectiveness, which basically means the electricity bill for the tenant is lower. It's a win-win.
And finally, on the moat, we have switching costs. I love this detail in the report. It's not like moving an office where you just pack up some boxes and call a moving truck.
Not even close.
Yeah.
If a tenant like CoreWeave wanted to leave an APLD facility, they would have to power down a massive cluster. We were talking about physically unbolting thousands and thousands of servers, transporting incredibly sensitive electronics that cost tens of thousands of dollars each, and then re-racking them somewhere else.
The downtime alone would be a killer.
The downtime would cost millions. The logistics are a nightmare. So once a tenant moves in and their cluster is running, they are physically and contractually locked in for a decade or more. It creates a very, very sticky revenue stream.
So they have the power, they have the speed, and they have the tenants locked in. But a company is only as good as the people running it.
That's the next piece of the puzzle.
Chapter 2, Management Evaluation.
Let's talk about the jockey riding this horse. The CEO is Wesley Cummins.
And what stood out to me is his background. He's not an engineer. He didn't come out of Intel or Google or some big tech firm. He's a finance guy.
He ran a hedge fund called 272 Capital. And for this specific phase of this specific company, that is actually a massive asset. If this were a software startup, you'd want a visionary coder as CEO. You'd want the next Zuckerberg. But Applied Digital is an infrastructure play. It is a capital allocation game.
It's about spreadsheets and debt covenants, not code.
Exactly. The job is raise money, buy equipment, build buildings, and manage a very complex balance sheet. He needs to speak the language of Wall Street, not necessarily Python.
And his track record kind of proves he can navigate tough waters, right?
It does. I mean, remember, he steered this ship through the crypto winter. When Bitcoin crashed, a lot of hosting companies folded because they couldn't manage their leverage. They just blew up. Cummins managed to pivot the entire corporate strategy to AI without going bankrupt. That required really fast decision-making and a very sharp pencil on the financials.
And now he's making another huge strategic move, the spinoff. We mentioned the two segments earlier, the boring landlord and the flashy tech rental. He wants to break them apart. Why go through all that hassle?
This is classic financial engineering, and it's designed to unlock value. Right now, the market is confused. Investors look at APLD and they ask, are you a boring, stable REIT that I should value based on EBITDA? Or are you a high-growth, risky tech stock that I should value based on revenue multiples? By keeping them together, the stock gets what's known as a conglomerate discount.
It's like selling a house and a Ferrari as a package deal. The real estate buyer doesn't want the car, and the car collector doesn't want the house, so you end up getting less for both.
That is the perfect analogy. So the plan is to spin off the cloud services business into a new public entity called Chronoscale. It's merging with a company called EK Also Bionics, which is already public, as a way to get to market quickly.
A SPAC-like maneuver?
Essentially. The idea is that Chronoscale can trade like a pure-play tech stock, high volatility, high multiples, attracting growth investors, while the remaining APLD becomes a pure-play infrastructure stock, which attracts a totally different kind of stable, long-term investor, like a pension fund.
And APLD retains about 97% of Chronoscale initially, right? So they aren't just giving away the upside.
Correct. They keep control, but they create a new currency, the Chronoscale stock, that they can then use to buy other companies or reward employees without diluting the main APLD shareholders. It's a very savvy financial move.
Okay, that's smart. We also have to talk about who is backing them. It's not just retail investors on Reddit who are excited about this.
No, and this is a key validation point. This is huge. They secured a $5 billion preferred equity facility with Macquarie Asset Management.
And Macquarie is a big deal.
Macquarie is one of the biggest, most respected infrastructure investors on the planet. They own airports, toll roads, utilities, cell towers. They are the smart money in this sector.
And they wouldn't just throw $5 billion around.
Absolutely not. For Macquarie to sign a check of that size, you can bet they did months and months of brutal due diligence. They've looked at the contracts, the power permits, the engineering reports, the management team. Their involvement signals to the rest of the market that this isn't some vaporware project. The assets are real and have been vetted by the best in the business.
Okay, so the management is savvy and the big banks are on board. But let's look at the checkbook, because this is where things get really, really tight.
This is where the story gets its tension.
Chapter 3, Financial Health.
All right, let's get into the numbers. We have the figures from their fiscal Q2 2026, which ended back in November 2025.
And on the surface, it looks like an absolute rocket ship. Revenue came in at $126.6 million. That is up 250% year over year.
It's a massive jump. The headline number is fantastic. It confirms that the huge backlog of contracts they've been announcing is finally turning into real cash hitting the bank account. This was driven largely by the energization of their Polaris Forge 1 facility in Ellendale, North Dakota.
But with these things, when you dig into that revenue number, there's a pretty big catch, isn't there?
There is. A significant chunk of that revenue, about $69.5 million of it, was what we call tenant fit-out costs.
What does that mean?
Essentially, their main tenant, CoreWeave, said, "We need the room to look exactly like this, with these specific racks and this specific networking." So APLD paid the contractors to do all that custom work, and then they billed CoreWeave for the cost. APLD books it as revenue, but they also book the identical amount as a cost.
So it's a pass-through. It inflates the top line, the revenue number, but it has zero margin. It doesn't actually make them any profit.
Exactly. It's basically a wash. It makes the growth chart look amazing, but it doesn't help the bank account much. Now, if you strip that out, the core hosting business is still healthy. It's operating at around a 38% margin, but that headline revenue number is a little bit misleading.
Okay, so that's revenue. Let's talk profitability, because the bottom line was a net loss of $31.2 million. They are losing money.
In accounting terms, yes, they are. But for a company like this that is building massive, long-lived infrastructure, net income is often negative because of depreciation. You have to write off the value of the buildings and equipment over time on paper, even though they're still generating cash.
So what's a better metric to look at?
The number we really care about is adjusted EBITDA. That's earnings before interest, taxes, depreciation, and amortization. It gives you a cleaner picture of the cash-generating power of the actual operations. And that was a positive $20.2 million for the quarter.
Okay, so they're operationally profitable. The core business is making money. $20 million in a quarter sounds decent.
It is decent, but here's the problem. $20 million a quarter is roughly an $80 million annual run rate. Now let's look at their debt. They have about $2.6 billion in total debt on the balance sheet.
That's a pretty big number.
A very big number. And the biggest chunk of that is $2.35 billion in senior secured notes.
And those notes are not cheap.
No, they are not. They carry a 9.25% interest rate.
9.25%. In this rate environment, that's high.
It's very high. The credit markets are basically pricing this as junk debt. It signals high risk. Now, if you do the math, 9.25% on $2.35 billion is roughly $217 million a year in interest payments.
Whoa, wait, let me just process that.
Huh?
They are generating about $80 million a year in operational cash flow, but they owe $217 million a year just in interest.
Correct. They are currently burning cash just to service their debt. This is the bridge they have to cross. This is the central drama of the company right now.
So they're losing over $100 million a year in real cash.
They are. They're betting that as more buildings come online, specifically the rest of Polaris Forge 1 and the new massive Polaris Forge 2, their EBITDA will skyrocket, eventually overtake that huge interest payment. But right now, they are bleeding.
That sounds absolutely terrifying. How do they possibly survive that kind of burn rate?
The balance sheet. This is their life support. They have a massive war chest. As of the last report, they had $1.91 billion in cash and cash equivalents.
Okay, so they have a cushion.
A huge cushion. That money gives them the runway to finish construction and pay that interest until the rent checks get big enough to cover it all.
So it's a race. It is a literal race against time to get the buildings built and the tenants paying before that $2 billion cash pile runs out.
That is the perfect way to describe it. It is a race against the burn rate. And that negative return on invested capital, or ROIC, of negative 2.9% reflects this perfectly.
Yeah.
They've spent all the money to build the factory, but the factory isn't running at full speed yet.
That is a high-stakes poker game. And speaking of high stakes, let's take a quick break. When we come back, we're going to talk about the stock itself, the army of short sellers trying to crush it, and the massive risks that could derail this whole train.
Don't go away.
Like and subscribe to Stock Analytics AI.
Want institutional-grade stock research without the institutional price tag? Check out stockanalytics.ai. For just $10 a month, you get full access to our deep dive video library, covering over 600 S&P 500 and NASDAQ 100 stocks, each with full source citations you can verify.
Can't find the stock you're looking for? Request analysis on ANY ticker and download your own video within 24 hours.
Upgrade to Pro for $20 a month and unlock our SEC Risk Scanner, which detects red flags in company filings before they hit the headlines. Plus our Portfolio Diversification Analyzer to optimize your holdings.
Start your 7-day free trial today at stockanalytics.ai. Make smarter investment decisions with research you can trust.
Part 2, Chapters 4 to 7, Market Sentiment, Ownership, Risk, and Final Conclusion.
Chapter 4, Market Sentiment.
We are back. We've looked at the business, the management, and the very scary math of their debt.
Right. Now let's look at how the market is reacting to all of this. Because APLD is a polarizing stock.
Polarizing might be an understatement. It's a genuine battleground. As of today, February 7th, 2026, the stock is trading around $34.95. The 52-week high was over $42. But the key number is that it's up 343% in the last year.
So if you bought this a year ago, you are popping champagne.
You're very happy. But not everyone is celebrating. There is a massive group of people betting this company is going to zero.
Short interest.
Yes, the short interest. This is the percentage of a company's shares that have been borrowed and sold by traders who are hoping to buy them back cheaper later. Right now, a staggering 30.79% of the float is sold short.
30%. That's an incredibly high number, isn't it?
It's astronomical. For context, anything over 10% is considered high. 20% is very high. 30% means there's a very crowded theater and a very large, very well-funded group of people are all yelling, fire.
So why do they hate it so much? Is it just the debt?
It's primarily the debt and the cash burn. Sophisticated hedge funds look at that negative cash flow we just discussed. They look at that 9.25% interest rate, and they say, this is unsustainable. If they stumble, if construction is delayed by even 6 months, that cash pile disappears and the equity is worthless. They see it as a junk bond masquerading as a hot AI stock.
But this creates a very dangerous situation for the shorts themselves, doesn't it? This idea of a squeeze.
Oh, it's a huge risk for them. It's a double-edged sword. The days to cover ratio is 2.63. That means it would take nearly 3 full days of normal trading volume for all the shorts to buy back their shares and close their positions.
So they can't get out quickly if they need to.
Exactly. So if good news hits like a new lease announcement or a surprise positive earnings report or even a hint that the Fed might cut rates, the stock price jumps. The shorts start losing money fast. They panic and try to buy shares to close their position and stop the bleeding. But that buying pressure from the shorts just drives the price up even further, which causes more shorts to panic. It's a vicious feedback loop.
We saw this happen just yesterday, right? The stock jumped 25% in a single day on February 6th.
That has all the hallmarks of a short squeeze. It creates its violent volatility. So if you are an investor in this, you have to have a really strong stomach. This stock will not drift slowly up or down. It will gap up 25% and crash down 20%. It's a roller coaster.
A roller coaster with a lot of people on both sides of the bet. And stuck in the middle of this are the actual owners of the company.
The people with the real skin in the game.
Chapter 5. Ownership structure.
So let's look at who's actually holding the bag, or the gold mine, depending on your point of view.
We talked about Wes Cummins, the CEO.
Right. And he has serious skin in the game. He owns about 7.6% of the company, which is over 22 million shares. At the current price, it's a lot of money.
I saw a headline that he sold some stock back in January. Is that a red flag? You know, the classic CEO dumps shares at the top.
It sounds bad on the surface, but you have a look at the context. He sold about 165,000 shares for roughly $6 million. Now, that sounds like a lot of money to us, but it's less than 1% of his total holdings.
That was a drop in the bucket for him.
A tiny drop. After the stock ran up more than 300%, any financial advisor would tell you to take a little bit of money off the table. Buy a house, diversify your portfolio. It's just prudent financial planning. he is still heavily aligned with the shareholders. If the stock tanks, he loses hundreds of millions of dollars.
Okay, that makes sense. Fair enough. What about the big boys, the institutions?
You've got the usual suspects. Vanguard is the biggest holder with 8.65%,
Yeah.
and BlackRock is right behind them with 6.62%.
So the big index funds are in.
They are. These are the passive giants. Their presence helps stabilize the stock a little bit because they aren't day trading this thing. They're holding it because it's in their indexes. It adds a bit of a floor to the price.
But the most important relationship APLD has isn't with a shareholder, it's with a customer. We have to talk about CoreWeave.
CoreWeave is the elephant in the room. For a long time, and even now to some extent, APLD was seen as just a CoreWeave shop. Almost all their revenue was coming from this one single tenant.
Which is a massive concentration risk. If your only customer gets a cold, you get pneumonia.
Exactly. If CoreWeave goes bust or decides to go with another provider, APLD is in a world of trouble.
But that narrative changed pretty dramatically with the new lease at Polaris Forge too, didn't it?
This was the game-changer news that likely sparked that recent short squeeze. They announced they signed a 15-year, 200-megawatt lease with a major U.S. investment-grade hyperscaler.
And they haven't named them, but investment-grade hyperscaler is a very small club.
It's basically Microsoft, Google, or Amazon. Maybe Oracle. That's the list.
And the value of that lease?
It's massive. Approximately $5 billion in revenue over the 15-year term. This one contract does two critical things. Yeah. First, it proves that APLD isn't a one-trick pony. It proves that the biggest, most credible companies in the world, not just high-flying startups like CoreWeave, need what APLD is building.
Yep.
And it de-risks the business significantly in the eyes of lenders. When they go to refinance that 9.25% debt, they can walk into a bank and say, look, we have a 15-year contract with an AA-rated company. That makes them a much safer bet and should allow them to get a much lower interest rate.
Okay, so they are diversifying. That's a huge positive. But let's be real, there are still plenty of ways this could go wrong.
Oh, absolutely. The risk profile is still very high.
Chapter 6, Risk Assessment.
Let's explicitly label the monsters under the bed here.
We've touched on the debt, but let's put a fine point on it. The biggest, scariest one is clearly the debt wall.
It is the primary risk. It's not just the 9.25% interest rate, which is a heavy burden today. There's also refinancing risk. Those notes are due in 2030. But ideally, they want to refinance them much sooner at a lower rate once the cash flow improves.
What happens if they can't?
Well, if interest rates in the broader economy stay high, or if APLD stumbles and their credit rating doesn't improve, they might be stuck paying that exorbitant rate for years and years. And that just eats up all the potential profit that would otherwise go to shareholders. It puts a ceiling on the stock price.
And we just mentioned customer concentration. Even with the new big lease, they are still heavily tied to CoreWeave for their current revenue.
Yes. CoreWeave is a darling of the AI world. Right now, they're growing like a weed, but they are still a private startup. They are in a brutal war competing against the trillion-dollar giants. If CoreWeave loses the AI race, or if they decide to vertically integrate and start building all of their own data centers instead of renting from APLD, that's a huge problem.
What about the macro factors, the things outside of their control? The report mentions something interesting, the tariffs of 2025.
This is a very real physical risk. Building a data center requires massive amounts of steel and very specific, complex electrical components like transformers. A lot of that stuff comes from overseas. The new tariffs introduced in 2025 have spiked the cost of these materials pretty significantly.
So if the cost to build the data center goes up by, say, 20%, but they have already signed a fixed rent lease with a tenant,
their profit margin gets crushed. They might have budgeted $10 million per megawatt to build a facility, but if tariffs push that cost to $12 million, the return on their invested capital drops significantly. It just makes the business less profitable.
And then there is the grid itself. We talked about how great North Dakota is for cheap power, but it's also North Dakota. It gets really cold.
Extremely cold. Regulatory and grid stability is a hidden risk that people don't think about. If there is a massive polar vortex, a once-in-a-century storm, and people's homes are freezing, the state grid operator might be forced to make a tough choice. They might call APLD and say, sorry, data center, we need that power for residential heating. You have to turn off the servers.
Curtailment.
Exactly. It's called curtailment risk. And if your tenant is in the middle of a model training run that costs $100 million and you pull the plug on them, that is a disaster. It could lead to breach of contract lawsuits. It's a mess. APLD has backup generators, of course, but running a 100-megawatt facility on diesel is incredibly expensive and creates its own logistical nightmares.
So it's definitely not a slam dunk. There are very real, tangible threats. Which brings us to the final verdict.
The bottom line.
Chapter 7, Conclusion.
Let's wrap all this up. We've unpacked the business, the money, the market sentiment, and the big risks.
When we look at the valuation today, where do we land? Is it cheap? Is it expensive?
Let's look at the numbers. The enterprise value, that's the market cap, plus the debt minus the cash on hand, is around $10.5 billion. Now, if we look at their projected EBITDA based on their signed contracts, their backlog, once everything is built and running at full capacity, we can estimate maybe around $477 million a year.
So what's the multiple on that?
You're paying about 22 times future EBITDA.
22 times. For a landlord, a real estate company, that seems rich. Usually data center REITs trade at 15 or 16 times EBITDA, right?
Correct. So it is not a bargain bin stock.
Yeah.
This is not a deep value play by any stretch of the imagination. Investors today are paying a significant growth premium.
What does that mean?
They are paying extra because they believe in the pipeline. They believe APLD won't just stop at the current 600 megawatts they have under contract, but that they will grow to 1,000, then 2,000, then 5,000 megawatts. They are paying for the future growth that isn't yet secured. They're paying for the scarcity of power.
So if you are looking for a margin of safety, that classic Benjamin Graham idea of buying a dollar for 50 cents, it's just not here.
Strictly speaking, no. The current price of around $35 a share assumes flawless execution. It assumes the buildings get finished on time, the tenants pay their bills for 15 years, and the debt gets refinanced at a reasonable rate. If any of those things break, the stock price is a long way to fall.
So how do we verdict this? Who is the stock actually for?
I think we have to split it into two distinct camps. For the conservative investor, the person who wants safe, steady returns, who prioritizes capital preservation, this is way too risky. The negative cash flow and the high debt are immediate deal breakers. It violates rule number 1. Don't lose money.
Stay away.
Stay far away. But for the enterprising investor, the investor with a higher risk tolerance, who wants direct exposure to the AI infrastructure boom but thinks NVIDIA is too expensive or too obvious.
Yeah.
For that person, this is a very compelling, if speculative option. It is a rare pure play on the physical layer of AI. The thesis is simple. AI needs power. Power is scarce. APLD has secured the power. If they can cross that bridge of cash burn, if they can just survive the next 18 to 24 months, this could be a massive compounder for years to come.
It really is the industrial landlord of the 21st century. We get so caught up in the code and the chatbots and the software, but the AI revolution is ultimately made of concrete, copper, and cooling systems.
And APLD owns the dirt where the future is being built.
Yeah.
They borrowed a lot of money to buy that dirt.
A fascinating high-stakes story, a real nail-biter.
It really is.
That brings us to the end of this deep dive. We want to know what you think. Is the debt a deal breaker for you? Or do you believe in the power scarcity thesis? Let us know in the comments.
And before you go, don't forget to like and subscribe to Stock Analytics AI.
Just a quick reminder, this deep dive is based on AI research and source materials for informational purposes only and does not constitute financial advice. Please do your own due diligence.
Thanks for listening, and we'll see you on the next one.